Thank you so much for tuning in to Exit Ready. Hope you enjoyed today's episode. We're going to unpack ways for you to make your company more valuable so that when you get ready to exit, you can get the most money possible. Now to the show. Jonathan, man, it is good to finally see you face to face. We've spoken on X and I had a phone call. It's nice to finally see you and talk to you. How's it going, man?
Going good. It is great to be on here and great to see you as well.
Okay, give a quick introduction for people who don't know who you are and what you do.
My name is Jonathan Schaff. I am the founder of Schaff Accounting, where for the last 15 years I've been helping business owners manage their taxes more efficiently. And also we do bookkeeping and some elevated services as well to basically make their tax life and their financial life as a business owner as stress-free as possible.
Have you yet to find an owner who likes the IRS?
That's a good question. So most business owners do not like paying taxes. I mean, who does, right? Most owners definitely don't like dealing with the IRS, and that's
Mm-hmm.
something that my firm can solve for them if they have a tax issue and they are, signed up for our tax management services. We can contact the IRS or their state on their behalf and help them resolve their tax issue, no problem on their part.
Okay, so you said that you do CPA work and bookkeeping work. Now, some people might go, that's kind of the same thing, right? I've got a bookkeeper or I have a CPA. What's the difference between those two offerings?
Great question. So for bookkeeping, if we're doing your business's bookkeeping, that's great. We are going to be in your QuickBooks file weekly, keeping it updated, maintained, accurate. My team's going to be asking you questions on, different transactions that we need to know more information about, or if we see anything that is a little bit suspicious, we'll be notifying you about that as well. For our tax management services, that is an all-encompassing service that will help business owners take care of their tax needs. And it goes beyond just tax preparation and filing, which is what most accounting firms do for business owners. They want to take all your documents in every year for tax season, prepare the return, get you to approve it, sign it, file it, and then they never speak to you again until the next tax season, right? You have problems getting your questions answered. If you're a business owner, your business is changing a lot, as all are, and you're going to have accounting and tax questions that pop up. Average accounting firm won't answer your emails timely. Hard to get in touch with anybody that can has the expertise and knowledge to guide you through whatever your challenges are with your business from a tax standpoint. And then additionally, one thing that business owners should consider is tax planning. That is a service that is above and beyond just tax preparation and filing, to where you have a tax expert that can identify the proper tax strategies for your unique situation with you and your business that is going to give you a really good ROI on implementing. And in the long run, what it does is legally reduces your tax liability. If you're a business owner, there's a lot of different tax strategies that you can take advantage of that can be really good ROI, low hanging fruit, if you will. Additionally, if you're a business owner, you're not probably not an employee anymore of a company. Maybe it's your own company. But when you're an employee, you have tax withholdings. And if you're a business owner, you are taxed on your company's profit, the net income that's left over after expenses. However, there is no withholdings on those profits. So a lot of business owners are accruing a tax liability if your business is profitable, which, I hope it is. And our tax management service covers all of that. We help you resolve your tax issues if you get a tax notice from the IRS or your state. Additionally, we're preparing and filing your tax returns. We want to meet with you quarterly to go over tax strategies that could be beneficial to you and give you instructions on how to implement those properly. And then we have capacity to answer your questions as they come up, as they arise. As your business is growing and expanding, you might want to buy a building, buy equipment, buy vehicles, and those have tax consequences. And there might be a strategy or two that you could implement to make your taxes more efficient to where you're legally paying less. Our tax management service covers all of that, and that is how we serve business owners and provide the most value to them.
Yeah, I think a lot of owners, depending on the type of business you're running, um, they might be sitting here today figuring out how to lower their taxes in a way that probably won't flag an audit. But when they go to sell, the buyer is going to go, wait, how much money do you want for this business? But you're only showing that you paid this much on taxes. And that's not what you're talking about, because you can lower your tax bill through legal methods and the buyer can go, okay, this is what they did. But a lot of owners were like, oh, I built my house and I ran through the business, or I did this thing, I ran through the business and it didn't flag an audit because we're this type of company, or I've got a bunch of cash, I never reported it. And so how do you advise owners maybe on how to understand that that's actually going to cost them in the long run?
Great question. So you mentioned there in your potential, proposed scenario, one of them was, say building a house and running all the expenses for that through your business. Intermingling personal expenses and business expenses is definitely, red flag. In a sense, it is not compliant with current federal and state tax laws and highly not recommended. So one thing that our business tax management services will provide for our clients is to keep you compliant. If you were audited and it was discovered that you were, funneling a lot of personal expenses through your business, that audit's going to hurt. The results of that audit are you're going to owe a lot of money, and it could be even worse than that. We are, we advocate for our clients to be compliant with all federal and state tax laws. And so the strategies that we recommend line up with those laws. Those strategies are in the laws in a sense. And yes, if you are getting your business ready to sell and you have been funneling a ton of personal expenses to drive your business profits seemingly to zero, then it is going to be harder to sell your business for any type of money, any type of good price point, because you're intermingling personal and business finances. And it's going to be hard for that searcher, that prospective buyer of your business to determine what, when they look at your bookkeeping, it's going to be hard for them to determine what is personal expenses and what is business expenses. So they're definitely a lot less motivated to give you a good price for your business. And if you got audited by the IRS or your state, if your state assesses income taxes, and they see a lot of personal expenses flowing through your business, and those personal expenses wound up as actual expenses on your business tax return, then they're going to take away a lot of those business expenses and charge you back taxes with penalties and interest. And, so we would definitely tell a client that if they were doing that, tell them to stop, explain to them the consequences, and help them unwind all of that going forward with our bookkeeping services, et cetera. Get it all split out so it's compliant and it's better for everybody going forward.
And I was going to say, on top of that, is that if you're co-mingling, talk to a lawyer. We're not lawyers. I'm not a lawyer. You're not a lawyer to my knowledge.
Not a lawyer.
Okay. But you also could allow someone to pierce your corporate veil if you're sued because you're co-mingling. So, understand that when you're doing this stuff, it's not just a tax risk. It's like if something happened and someone sues you before you exit, before you do anything, then all of a sudden your personal assets could be at risk as well. So it's really risky, and it sounds good because you save this money on taxes, but the risk is really, really high.
Absolutely, yes. If your business is subject to a lawsuit and they find a lot of personal expenses in your business bookkeeping, and that those business expenses wound up as tax deductions on your tax return, because they're going to get all that information in the discovery phase of the lawsuit. If that is discovered, that you're basically intermingling personal and business expenses, yes, the corporate veil is much more easily pierced, and it's not going to be good for you in the long run. So it is just not worth it to intermingle business and personal finances. I know you can basically get out of paying taxes, but you're breaking the law. And, if you do it too much and you go under audit, the consequences will be worse than just paying back taxes. And you just don't want to deal with that. So definitely get compliant ASAP. That's my advice. It is so worth that investment to where you can sleep good at night. You don't have to worry about anything happens that way. If you go under audit, you're confident in your numbers. That's my goal for my clients. If you get sued, you're confident in your numbers. At least on the finance and tax side, they can be confident in their numbers. My clients can. And so that is great. A great question, or a great item to note there for sure.
Well, I think I'm curious your opinion on this because I think a lot of owners, and I'm sympathetic because of the era that we're in. Selling your business now is more mainstream than it's ever been. So I get it that if you grew up and you're maybe 60 or 65 or even 55, this is really more of a not a new concept, but the talk about it is a lot more main street than it was 5, 10, 15 years ago. And so now it's everyone's talking about it, it seems like. And so I get that maybe if you started a business in 95 or 2005, you didn't have selling the business in mind. Maybe you thought your kids would take it over, maybe not, but to sell it, you didn't really think about it. And so a lot of owners, it seems, don't really have how they're going to leave the business in mind. And they'll figure it out when they get there. And they don't realize that some of this stuff, like if you take an S Corp election and you're not maintaining that properly, they don't really understand that the risks that they're taking, and that someday they are going to want to leave the business, or they're going to die in the business. Like someday it's going to close down. They're going to exit the business. 100% owners do. And if they haven't kind of worked through some of this stuff and had a kind of a goal in mind, for where they were going towards, then it might make sense today to go, oh, let me just kind of not pay taxes on this. Let me kind of do this, because they don't have that end goal in mind. And if you had the end goal in mind, you'd go, oh, wait, this is going to save me X amount of dollars in taxes, $100,000 in taxes, we'll say, but it's going to cost me maybe $1 million when I go to sell or whatever. Or it might prevent me from selling because the S Corp's no longer valid and now it's a C Corp and I've got all these problems. And I don't think that it's just, is it a nature of the M&A world coming to the lower middle market in the past 5 years? Like, people are just now realizing this. Not that it hasn't always been true, but the knowledge wasn't out there. Like, why is it that so many owners don't kind of understand this from day one?
Great question. I believe that it is not necessarily a skill issue, but an education issue. A lot of owners, they don't come from a legal and accounting background. A lot of owners come from, other professional backgrounds, other careers that aren't involved in tax, accounting, or law. And so they need to get caught up on this information. It doesn't take a ton of effort, but it definitely pays off to, get a good lawyer when you're starting your business, or whether you're midway through your career of running your business. Or really any time, get a good accountant that's going to sit down with you and explain the nuance that you need to know as a business owner to get the most out of your tax returns, so you can be most tax efficient, as well as, tell your accountant, hey, I want to sell my business in X number of years. Let's start getting ready for that. What do I need to do as a business owner? Ask your accountant, what do I need to do as a business owner to get my business ready to sell and get the best price of it from an accounting and tax standpoint? And if your accountant isn't responsive, get a new one. Get one that's focused on business owners. Get one that's right for you. Same with your lawyer or any other vendor that you're using. So that way you can get the most out of owning your business and having it, and then possibly one day selling it. Additionally, I would say, you mentioned business owners kind of having their head in the sand about their legal and accounting and tax side of their business and not doing things right, and just really kind of messing themselves up and screwing themselves over in the future. And yes, it is a knowledge issue, but I think that additionally, it might be a goals issue, because if you're, 5 years into running your business, successful, you don't really have a plan to exit anytime soon. You don't have a plan of like, who's going to take it over if I get hit by a bus. If you don't really have that plan or goal in mind, then you really don't subsequently take action to make sure that that goal gets achieved, right? If you never set the goal, then why would you take action to see that said goal would get achieved? So I think that it behooves business owners to set a goal, have a business plan in mind, like a continuity plan, as to if you became incapacitated, what happens next? If you got a really good offer on your business, what happens next? Are you prepared to accept the offer? If if you have a plan, or if you ever desired one day to travel the world and your business won't allow for that because you need to stay local, then let's set that goal and start taking action to exit one day. And that's going to mean that you need to do things probably differently than you've always done it if you've never executed on the plan to exit your business. And so it may take some changes, but hey, us business owners, we're used to change. Change is inevitable, and we do best when we're adaptable. So, that would be my advice on those issues.
I love that, because if you're right now taking money so you pay less in taxes and running it as personal expenses, you could reinvest that money to grow your business, to hire those people, grow the business probably not as much as you think, and then do the things that you just mentioned. And that's kind of what gets lost. Like it's really, I will see, we talked about X a minute ago, that's where we met at. People talking about getting 10 million in revenue or 20 million in revenue. And if you hear owners who have gotten there, they'll talk about how tough it really was. And part of that comes from the fact they may have that goal. Most of us aren't cut out to do that. That's fine. But then part of it comes from just not knowing how much they need to actually just call it a day. Like they don't know. And so they're like, oh, I got to get to 10. But the sad part is I've talked to owners that are doing like $100 million and their business wasn't worth nearly what you would think it is. And so like all these things, you talk about having goals, and I've been studying a lot of business strategy, and it's interesting because business strategy, a lot of it is really for the big companies, and it doesn't really trickle down to the small guy. And I kind of get it, because Fortune 500 companies will pay a bunch of money for business strategy, but the small guy just needs to understand the strategy for them. It isn't as complicated as Coca-Cola has. But you got to have it, or you're going to fail. And so you mentioned like tax planning. Is it hard for you to talk to owners about, hey, let's sit down and have a conversation about what you're doing now? Obviously, is clear, but in the future, you talk about buying businesses, or doing stuff, or maybe going to an S corp or whatever. Like, are they usually open to that conversation, or if not, how do you get them open to that conversation?
Gotcha. So when business owners come to us, a lot of them come to us on the premise of like, hey, I've been paying too much in taxes. I own this business, been running it for years. I need somebody to help me pay less in taxes. I want to do it legally. Additionally, we have business owners that just have an accountant that's unresponsive, or we have business owners that want to get better about managing their tax liability, paying quarterly estimated taxes. And so that's kind of the reason, or that's the premises of why people come to us. And for people that want to exit their business, like if they mention that when they're at any point in our business relationship, whether they're already our client or just a prospect, that kind of, in a sense, it doesn't really change the game for us for the most part. But we definitely I would recommend that the business owner themselves, if they're not, a client of ours, if they're out there and they want to become exit ready, I would definitely recommend that they do, a few things. I think there's some low hanging fruit with these simpler steps. Is one, make sure that your bookkeeping and taxes are accurate. Get with a business accountant, a business focused accountant, small business focused accountant. It could be an accountant that focuses on just your business niche, but it doesn't have to be. Talk to your accountant about the exit that you want to have. Ask them about tax planning opportunities. Ask them, how can I save money in taxes on the sale of this business? If I sold my business for X dollars, how much am I going to owe in taxes? They'll probably tell you an estimated answer. Then ask them, how can I minimize that, legally speaking? What moves can I do today? And every situation is different. So the moves for you might be different than your friend that owns a similar business, down the street or out of state. But these are the first simple moves. Is taxes done accurately, bookkeeping is accurate. And then tax planning has taken place prior to the sale. So one thing that I hate to get is prospects, get them on a sales call and they tell me, I've never, as a stranger, never talked to them before. They say, "Hey, Jonathan, small business owner looking for tax planning services." I'm like, "That sounds great. We offer that. I think you can get a lot of benefit out of it." And I say, "Tell me more about yourself and your business." They're like, "Well, I'm under contract to sell the business and I just want to take my capital gains taxes that I'm going to owe from selling that business. I want to just become more tax efficient." And I'm like, "Okay, well, it sounds like you're going to sell your business soon. Is that correct?" They're like, "Yeah, a few months from now, probably close." Here's the problem. When it comes being exit ready and selling your business in regards to tax planning, it needs to take place years in advance of selling your business. So that way you can get the most out of the strategy. Some strategies take years. For example, the holy grail of all business sales tax strategies is QSBS. That's where you can sell a C Corp that you've held for 5 years under certain conditions. If you have met some qualifications, there is some nuance to it. You can sell it for a certain amount and you won't pay any taxes on the sale. And with the One Big Beautiful Bill Act passing, you can hold it for less than 5 years and sell it for even more than you used to be able to, and for tax free, pretty much. Now, of course, there is some nuance. There are caveats. Just because you have a C Corp doesn't mean that you automatically qualify. Talk to your accountant about that. Let's say you don't have a C Corp, you have an S Corp. That doesn't mean that there's zero tax planning moves that you can make to become exit ready. They're there, you just got to make sure that they're occurring. One thing I would ask your accountant, your tax pro, is what the basis you have in your business. What is your basis? And if they don't know, then you need to get somebody who does, because we want the highest basis legally allowed if you sell the shares of your S Corp. So that way you're paying the lowest amount of capital gains tax. Now, there's a lot that goes into determining your basis. But if your business accountant can't tell you what your basis is, or doesn't know, or can't find the numbers, then it's time to get another one. So that way you can get the best tax outcome from selling your business.
Yeah, I think what I would say is um, having a CPA is great. I'm not pro or anti CPA. I'm not making up, but understanding what your CPA's strengths are, right? That like where do they focus at? Because in some states they might focus on the state sales tax. Like that might be really their expertise. It might not be understanding federal tax strategies and stuff like that. So you really got to understand what their strengths are, and then how big or how small of companies they work with regularly, because the tax strategies are going to change depending on the size of the company that you have and your availability and stuff like that. So you really got to understand that. And I think that owners say, well, here's CPA in the phone book, AAA CPA, we call them up, cool. And they don't go through this process. And it's like, well, it's, this is important. This is really important. And you mentioned QSBS, and that's one of those things. It sounds too good to be true. There are caveats. Like my type of business won't qualify for that. I don't, unless there's a loophole I don't know about. Like consultants don't really qualify for that, so I don't qualify. But there are plenty of companies who can qualify. But you have to qualify, and that's the key. You have to qualify. And so understanding you have to qualify. But then if you go, okay, you're hearing this, you go, wait, C Corp, I thought LLC was the way to go. Why would I go to C Corp and don't have to pay more taxes and double dip on taxes over the next 3 to 5 years before I sell? Like, I get it if I sell in 5 years, but they could change the bill. Like, is there a risk going to the C Corp now? And so if an owner's hearing that, go, yeah, okay, if I do sell, that's great. But in the between now and then, like, what happens to me is it really worth the risk there?
So that's great points. Definitely in regards to choosing an accountant to serve your needs as a small business owner, ask them about their expertise, ask them what services they offer. And I would, if, my advice would be, if you're a small business owner, if you're looking for a new accountant, you're talking to a few that you might use, ask them about their tax planning services, because tax planning is in addition to tax return preparation and filing every year, right? And that's one thing that I think is a knowledge issue in the small business owner community, is that a lot of people think that tax planning and tax strategy recognition and implementation services come with the tax return preparation services, and that isn't just incorrect. The tax return preparation and filing services, that's just the most basic bottom of the barrel type of income tax services, right? That's just, the rudimentary items that need to be done every year, have to be done every year, but there's no strategy involved. So definitely interview your accountants and just ask them about tax planning service. Do they offer it? How much is it? What does it look like? Is it ongoing? Because really, if you're a business owner, your business is ongoing. And so you need to be in touch with your accountant on an ongoing basis, right? So make sure that you're getting the services out of your accountant that you need. And so your next question about QSBS. So yeah, you're right there. You got to qualify. And one of the major qualifications is that you make the list, right? So accounting firms are not, you can't do QSBS if you're an accounting firm. If you're an architect, can't do QSBS. If you're in a certain profession that's on the list, consultants, it's on the list, you don't qualify for QSBS. So you need another type of tax strategy in regards to ongoing basis, number one, and number two, in regards to selling your business, if you want to sell your business one day for, a high price. So let's assume that you make the list. Let's say you're a marketing firm. You make the list. Okay. HVAC company, you would make the list. So what needs to happen to be able to qualify for QSBS? You're going to need to become a C Corp for 3 to 5 years before you sell your business. And yes, C corporations have, in essence, a double dipping of income tax assessment, right? So the C Corp itself is going to pay taxes on its net income. And then if you draw dividends, do an owner draw, that's taxed as dividends. So it's taxed again. However, there's different moves you can make to, potentially avoid some of the double dipping. It kind of depends on a lot of factors, your household income. It also depends on the factors of like how profitable is your business. One other thing to note is if you have like a high household income, so let's say you have earnings from other businesses, maybe family trust, or you have a high earning spouse and you're in the 37% tax bracket, you don't really need extra income from your business, then it probably behooves you to be a C Corp, because the C Corps are taxed at a 21% flat tax rate. So if you don't even need income from your business and you can sell it as a QSBS, you qualify, then it might as well be a C Corp anyway, because you're not going to really need the dividends from the business. But if you can sell it for a high price later on and get, a big, windfall of money and get it tax free, then that's what you want to do. If you're a lot more than 3 to 5 years out from selling your business and you want more tax efficiency and you're not a super high income household, then maybe you want your business to be an LLC or an S Corp first. So that way you can get some more tax efficiencies from those entities, especially the S Corp in a lot of situations, maybe not every situation, but a lot of them. So that's something you could do. You could be an LLC, elect to be taxed as an S Corp when the time is right, but then also have your eye on the prize of QSBS. So what does that really mean? What does that look like? What are all the steps in the timeline? So number one, you're going to need to, if your business is an LLC, it's, let's say an S Corp, and you want to get QSBS. Well, before, let's say 6 years out, before the 5-year timeline, or maybe the 3-year timeline, talk to your accountant to see what is best for you. Before that, you're going to need to transfer your business to go from basically, you're going to need to spin up a brand new entity. You're going to need to spin up a C Corp. Hold on 1 second. I hope this is going to be edited. Awesome. So to spin up a C Corp, it takes a lot of steps. You need to do it through an attorney that is, competent in creating business entities and forming them. All of the assets of your old entity, your old S Corp, your old LLC, they need to be legally transferred into your C Corp, your brand new C Corp that is going to be used to qualify for QSBS. Let's say your business originally was founded as a C Corp. You elected it to be taxed as an S Corp for more tax efficiency. And you say, Jonathan, I'm going to do QSBS. I have a C Corp that's taxed as an S Corp. And I'm just going to revoke my S election right before I sell my business. That doesn't work. You're still going to have to create a brand new business entity, most likely, to qualify for QSBS. So, in regards to tax planning for QSBS, you need to do it many, many years in advance of selling your business. And you might have to start a brand new C Corp to qualify for it, which takes time, effort. It needs to be done right. You wouldn't want to get to the selling point when you spun up this new C Corp. Let's say you didn't do it right because you did it through LegalZoom or something like that. And then you have a searcher that's doing due diligence on buying your own business. And then they discover that all of your business's assets are still owned by some other entity. Well, they want to buy that entity that owns all your business assets because you didn't successfully do the asset transfer. And that other entity is probably an LLC or your S Corp or something like that. It's not a C Corp. Or it's a C Corp that doesn't qualify for QSBS because it was at one time an S Corp. So that's why, if that happens, then it's going to really screw over the searchers and your own hope for qualifying for QSBS. So in short, there's a lot of steps that need to take place for being exit ready on the tax planning side of things. Start early, start many years in advance, get a good business accountant. Probably also need a good business lawyer as well to make sure that you start, form a good plan for being exit ready, and you can achieve your goals, whatever that is, potentially qualifying for QSBS or selling your S Corp tax efficiently with those strategies. Whatever it is, start early so you can achieve your goals of being exit ready and exiting tax efficiently.
Yeah. And going back to what you said earlier about the personal expenses and business expenses, I'm guessing it's harder to run personal expenses through the C Corp and hide that, or is it kind of the same if you know what you're doing? Not recommending this, of course, but I'm saying, like, if an owner's like, oh, I use a bunch of personal expenses in my business and I go to C Corp, there probably have to be a lot tighter on the books, if I had to guess, to maintain that status, right?
Great question. So when businesses are corporations.
Mm-hmm.
So that means you have an LLC or a C Corp that elected to be taxed as an S Corp, or you just have a straight up C Corp. And partnerships are one of these types of businesses as well. If you have an S Corp, a partnership, or a C Corp that is doing over $250,000 in top line revenue, or it has $250,000 or more in assets, then it has extra layers of income tax reporting that is required to take place. Those extra layers are basically, in addition to reporting your P&L on your income tax return for your business, you're also going to be required to report balance sheet items. So that is assets are cash, equipment, the amount of accounts receivable you have, people that owe you money, that's an asset. Additionally, you're going to, liabilities, that's the amount of money that you owe, different people. Maybe it's your vendors or you have some loans, and then equity. And so you mentioned, is it harder to hide things if you have a C Corp? Yes and no. It can be done. If you have a C Corp or an S Corp or a partnership and you're over that $250,000 threshold, you need balanced bookkeeping. And if it's not balanced, it's going to show up on the tax return. And then either an auditor or a searcher who has really good due diligence processes is going to discover that your books aren't being done right. So yeah.
Yeah, and not advising people to do this. I'm just saying, like, understand if this is you and you are kind of doing this. When you go to C corp, it's just different. So don't mess it up. That's the key thing here. Don't mess it up. And you said earlier on it takes 3 to 5 years for tax planning. I can't remember exactly what you said, but a lot of owners don't realize that. And this is the whole thing here. It's like some of this stuff is it's impossible for one person to know. What I tell owners all the time is you're an expert at the roofer, the HVAC, whatever. That's your expertise. I know what I know, but I'm not a QSBS expert. Go talk to someone about that. Go talk to someone about this. Go get a business, and you just have to have a bunch of different people to help you so that you maximize the value of your company and you protect your assets the best you can, and you lower your tax bill. If you're not selling for 10 years, it doesn't matter. The better you plan this stuff out, and I've tried to really try to help owners understand. In business, it's so weird because we talk about it as if it's something unique, but it's really not. It's really just, if I put a tweet out yesterday about a sports team. If they hired a coach, they said, "Coach, what are you going to do with the team?" He goes, "I don't know. We're going to try to win more games." "Are you going to win the championship?" And he's like, maybe, yeah. They would fire that dude. Like, no. And so we don't talk about exits for some reason because the dream is to have it forever. But by not talking about it, we are actually hurting owners. And I'm not trying to tell owners like, "Hey, call me up. I don't want to sell your business for you." So I'm not saying that. Just being practical, like by not even having that end goal in place, they're really hurting themselves because they're not having a strategy to maximize and to benefit the most. And yes, there are the dudes who make it through their whole career skirting the IRS and they keep more cash. But what happens more times than not is you talk to your buddy and your buddy's like, "Yeah, we sold for a 5x multiple or whatever it is." Then you go to market and you get a 2x multiple and you're like, "Why? I thought this." It's like, well, your buddy actually did it the right way. Like, he actually did it the right way, and it cost you. And when we talk about multiples, if the EBIT is $1 million, well, a 2x to a 5x, that's $3 million. That's a lot of money. And so yeah, you saved a little bit of taxes, but it cost you $3 million at the end, and probably $3 million when you need it the most, right? And so anyways, I'll give you the final word. How can people find you? Anything I missed there? And we thank you for your time. I'm gonna let you get out of here after. I don't even know, I'm rambling now, but thank you for your time, I should say. We'll fix that in post. So
Absolutely. People can find me on X under @JonathanSchaff. And additionally, you can find me on my website and book a call with me if you're interested in our services. Love to chat with you. Love to learn about your business and what you do. And feel free to comment or send me a direct message on X or an email. Those are probably the two top ways to get in touch with me. Is I check both of those very frequently. And I look forward to interacting with you and our listeners, our viewers here on X. And feel free to just drop a comment on my post, and let's get in touch.
awesome. Thank you so much for your time today.